maybe what we've got is a growth shock. Now, growth shocks are really normal after recessions. We get the big whoosh after recession. The fiscal stimulus comes through, it all comes through, then the fiscal stimulus fades off, and what we tend to see is growth come back down again. We tend to see the central banks stopping trying to tighten and stuff like that, and I'll come on to that later. And then the economy recovers. It kind of, people fear a second double dip recession, and it doesn't happen. That's still kind of my base case. I'm not sure because it's really close, but this equity not going down suggests that maybe we hit stability. Even if we get to zero GDP growth, maybe we don't go anything lower. But let's see. It's all to play out probably in the next 6 months. So this is not going to be an instant fix here. We'll see this growth coming through in the next few months, I think.
The cryptocurrency traded with lower volatility over the past 24 hours compared with the recent sharp sell-off in price. Choppy price action over the past week continued to reflect uncertainty among traders, especially as macroeconomic risks linger. Let's see what Raoul Pal thinks about this volatility. Hello and welcome to Money Talks. In today's video, Raoul Pal analyzes the different sectors of the economy, including crypto, commodities, equities, and gold. He also explains the trends going on in their price actions. Raoul believes that we are witnessing a transition from inflation to a slow growth, and this will eventually create an opportunity for long-term buyers. Make sure to stick around till the end of this video, where Raoul Pal explains the concept of demand destruction and how to protect your capital. So without wasting any time, let's dive right into the video.
Inflation is peaking. It has caused demand destruction. Growth is slowing fast. We may get a recession. I don't know. Doesn't really matter. The outcomes are the same. There's a period of transition that we've got to go through. The transition is inflation to slow growth. And I think the market may take every position out and shoot it. Everybody's invested in oil, mining companies, cyclicals, anything might get shot in this equation. So we need to be really careful. Transitions are very dangerous points. So be careful over this next few weeks, maybe month or two, where we start seeing the transition as the market gets comfortable with what the new view is. I think the Fed go on pause, and I've said this all the way through since last year. They'll probably pause by the summer. I still think they do. Let's wait and see. I think they are. As I said, I want to be looking to buy growth. I want to be looking to buy bonds. Haven't pulled the trigger on bonds yet. I'm close. Started pulling this averaging in over 8-week period for the growth stocks. Gold, I cut my gold position recently. I've had it on for a long time. I just, I'm worried that it's going to get caught up again in another correlation one sell-off. And gold hasn't done as well as crypto. I prefer the crypto bet, but as part of a portfolio, those of you who want to own gold prefer it. I think it's going to do very well over the next, 5-6 years. So, load up into any sell-offs. Crypto, ditto. I mean, my views on that. And the commodity story, it is real. Copper is structural shortfall and will be for at least a decade, maybe longer. Will we find other ways of conducting electricity at scale? Probably. But that doesn't alleviate the problem now. We don't have enough copper. We can't get it out of the ground fast enough. And that's the issue. We've got this massive ESG revolution going on, and I think it's right, and we should be doing it. And I think it is going to create this incredible supply and demand imbalance because we're making demands of commodities we haven't got enough of while throwing massive amounts of capital. This is this fourth turning 1940s view, massive fiscal stimulus and fixed asset investment as we pile money into changing our energy source. In the meantime, we're not investing in the traditional energy source, so that equates to higher prices. I get it. Makes sense. And that's for many commodities. So that's going to happen for a while. And there are some commodities I want to own as a secular view, and others I'm not so sure about. And oil is one of the ones I'm not so sure about. But I'm not going to fade. I'm not, fade it. I might fade it for a trade, but I don't. I'm not concerned. Either way, I don't think the rate of change, because oil to go from $100 to $200 is only a 100% increase, and we've had a 300% increase already. So the rate of change is not the issue for inflation. So yes, commodity prices probably go up. Yes, we're probably in a secular bull market in commodities. No, it won't drive inflation. I look at business cycle because I find the cycle is predictable, because generally as the cycle turns and goes lower, it it follows all the way through until it turns back up and goes higher. You have many times where you have the cycle gets down to almost zero growth and comes back up again, driven by fiscal stimulus. And I'll talk about that period, particularly in the 2000s, where we saw that a number of times and why that happened, because it's going to have impacts for us in this discussion today. But what I've said to people is you need to understand what higher prices does to people. If you're not raising wages or you can't raise prices as a corporation, the high prices that you've got are demand destruction. They're a tax on consumers and businesses. So if I want to represent the tax in a different way, here is the gas prices at the pump in the US. We could use nat gas in Europe. There's a bunch of these things that are exploded. Food prices exploded. And what that means that these consumers have had to pay a tax. Their discretionary income has been more used now for the basic goods and services that they've needed. We've seen this in the past when healthcare costs exploded or schooling costs exploded. Both of those are moderated in recent years. But this is a shock that means people spend less on other stuff. We've seen stuff like restaurants rolling over because of stuff like this. The question is also, does demand destruction start destroying the demand for commodities? I wanted to understand demand destruction, whether it can change the price of oil as well. Could this be the thing that saves the markets from this hugely tight supply is lowering demand? Does that cause a big pause in the commodity rally or even a decent size reversal? I'm looking at the chart of oil and I don't know which way it goes, but it's looking to me that this is the GMI crash pattern. And the GMI crash pattern is it makes a peak, it then kind of messes around a bit, it creates a floor. When it breaks that floor, price accelerates lower. If that is the case, then again, it's going to add to my story that inflation is going to moderate because of demand destruction, and that the global economy is slowing faster, and it's going to change some of the equation. Now, we know that China's been tightening credit, and what we saw is a recession essentially in China. Now, Chinese never report negative numbers, but we've got essentially a recession in China, and they're starting to stimulate now, but it leads the world by 12 months. And the Chinese economy suggests we're going to get a full recession in the US. This maps to the global PMI too. Europe is pretty close to recession already. The German forward-looking indicators are suggesting that. And that is again driven by demand destruction of the higher inflation. We're also in Europe likely to see some sort of controls over the use of energy as they struggle with this shift of energy use into away from Russia into other areas. They're going to have this very high period of prices. And I think we're going to see demand destruction and forced demand destruction by shuttering or rationing some of the energy supply to some of the manufacturers. I mean, these are the extremities of the time, but when you've got war on your doorstep, the Europeans of all people understand the sacrifice that needs to be made. So I think that is something, and I'll talk a bit more about the sacrifices in Europe in due course when it comes to stimulus, which I think is the net outcome as ever. Now, when I look at other forward-looking data, I use the ECRI. We have Lakshman a lot on Real Vision, and he's my business cycle expert. The ECRI, the Economic Cycles Research Institute, their weekly indicator year on year has been falling very sharply and has come to very moderated levels and is following pretty much what I'm saying now, that I worry that if it starts to cross zero, then we're getting close to a contractionary phase. It's not there yet, but the warning signs are coming because of the speed of the decline. The only good sign is if I just take the index itself, not the year on year, it's not declining. It's been going sideways. And that suggests that maybe we avoid the recession.
Recently, the Bank of England hiked interest rates and warned the public about an economic downturn. That triggered fears of stagflation, or high inflation and slow economic growth, among investors. The BOE's grim outlook was the opposite of the U.S. Federal Reserve's upbeat tone on Wednesday, which temporarily assured investors that U.S. economic conditions could withstand higher rates. Overall, the shift from accommodative monetary policy to more restrictive measures has led to an unwind of speculative activity among global investors. That could be headwind for stocks and cryptos this year. Over the short term, price action remains neutral, and some altcoins have benefited from brief price spikes.
So that's a lot to dump. And again, I could talk a lot about commodities. You'll get so much in all of the interviews that I've coming in the next 2 weeks. It's going to solidify many of the things I've said here and argue against many of the things I've said here. Everybody's views are valid. This is an extraordinary time. This is one of the great macro markets of all time. And there is some great opportunities, I think, coming out of it. We've brought some of the single best money managers in the world to come on the platform. It's an absolute privilege to get these people on. And I expect you to invest your time in it. Take notes from everybody, figure out your own framework, and then navigate these times. At best, you'll protect your capital. At worst, you'll protect your capital. At best, there's a huge opportunity out there.
Over the past few years, Bitcoin's price has witnessed several highs and lows, and this has attracted a lot of attention from the world's media regarding the harmful effects of Bitcoin mining. Experts are predicting that Bitcoin mining might also adversely impact the cryptocurrency market in 2022, since more and more investors are opting for sustainable options for investment. Although mining of several cryptocurrencies has advanced from their initial stage of harmful cryptocurrency mining, there are still several major cryptocurrencies that use environmentally harmful algorithms using massive amounts of energy and leave major carbon footprints. Government authorities have urged crypto industries to look for alternative means to create more cryptocurrencies, including changes in mining methods. Experts believe that the falling state of Bitcoin and the rest of the crypto market is partly due to the adverse impacts of Bitcoin and crypto mining. Analysts expect this trend to continue through 2022 as miners in North America, Russia, and Europe continue to deploy more machines to mine Bitcoin. This growth indicates that those investors would start looking for more sustainable measures of investment, adversely crippling crypto investments in 2022. So what do you think about Bitcoin's price? Will we go up or down from here onwards? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.